Good morning, Joe. So we are back here, connecting this morning on Thursday, and a little bit of a chilly day here in Southwest Florida, but can't complain when I'm looking at a minus 15 Fahrenheit up north.
Yeah, certainly
Yeah,
can't complain.
yeah, no, for sure. I thought today would be a great conversation to talk about some of the myths of selling a company. Off screen here, we've been chatting about how most entrepreneurs know how to do certain things very well, creating a business, operating it, selling, marketing, managing contracts, projects. But the one thing that they have most of the time very little or zero experience in doing is selling a company. So I'd love for us to chat about the myths of selling a business, and
Yeah.
just we were talking about some interesting things just prior. So I think we can start just with that. Maybe what are some of the top myths of selling a business that you get into, because that's what you do. That is your business transacting. So yeah.
Yeah, yeah. So for those that don't know, Joe Pellegrino, I'm a partner and business broker over at Robbins Pellegrino, business brokerage firm. We deal in Main Street transactions largely. So think anywhere from, 2 million to 25, 30 million enterprise value. So we're not dealing in the massive mergers and acquisitions. We're dealing more in the Main Street, right? Um, for this is a good conversation for us to have because I deal with this all the time with prospective sellers. A lot of times when sellers come into our ecosystem, they're already at the point where they're ready to go. Like they want to sell tomorrow, whether that be because they've got a health event, they're looking to, create a liquidation event, whatever it may be. But either whatever it is, they want to go, now. We often say, man, would have been a whole lot better if we started talking a couple of years ago,
Right.
for a variety of different reasons, right? A lot of times, business owners, a lot of times it's not that they're not ready to sell because anybody's ready to sell at any point, right?
Mm.
And that's what we can kind of talk about as well. But a lot of times there are things that could have been done within the normal course of your current business that could have been done a year ago, 2 years ago, that could change what your business is actually worth.
Mhm.
So one of the things that we see often is that sellers think that the way that their accountants are steering them is going to be the very best thing. Now, here's the deal. Um, when it comes to selling your business, when it comes to M&A, we're not the IRS, right? The IRS is very important to follow, right? But a lot of the loopholes and ways to kind of, ways to get your money out sooner don't actually translate very well to the business sale process. For example, something really popular that accountants suggest to business owners is that you pay yourself partly in W-2, partly in distributions. The thing that business owners many times, in fact, almost literally 100% of the time don't realize is that part of what they pay themselves many times can be added back, but only if it's W-2. Distributions can't be added back to the bottom line. So at the end of the day, whatever you're taking out in distributions doesn't count towards your valuation, doesn't count towards your seller discretionary earnings. So that's that. In some cases, that can be a really, really big issue. Now, obviously, I know why CPAs suggest that to business owners. You know why. I mean, we all run our business on the day to
Optimal
day.
fiscal footprint, right? Yeah.
Right, exactly. We want to pay as little taxes as we possibly can, right? So at the end of the day, we're steering, we're steering our books in that way. But that really does a lot of times present a problem from a valuation perspective because it shows up on the balance sheet. That's good context. If it shows, unless it shows up on the P&L, does it really matter towards that valuation? So it just doesn't get the credit that you'd want it to. So that is typically the very first thing. If I have somebody that's looking to sell in 2 years to 3 years, that's one of the first things I say to them is, hey, start paying yourself 100% of W-2. Take the hit now, right?
Mhm.
You know,
Right. Yeah.
you're gonna get the benefit, you're gonna get the tax benefit in the short term, but in a sense, you're kind of getting you're kind of getting your cash out now, right? You almost look at like what you're gaining from what you're gaining from a tax perspective in these next 2 years as well. That could have been even greater had you waited, had you deferred that in a sense to your sale. Does that make sense?
Yeah, that makes a lot of sense, Joe. And I know I didn't officially present myself in the beginning, but as founder of Espresso Ventures, I accompanied, a few hundred companies at this point in the last decade and a half. And I'm always on the growth side, working with the founders and entrepreneurs, and it's definitely more in the tech industry as well. But
Hmm.
from seeing a few outcomes and some really incredible outcomes, I think another myth that I would love for us to talk about is the myth that if I have a very fast growing company in the last 2 years, went from, hypothetically like 10 million to 15 million or 20 million, that is for sure going to be great on the valuation and the exit output. So I want us to, I know we talked about this in the past. I want us to chat about how, a hockey stick growth doesn't necessarily mean you're getting the best, output and sale price for the business. And while, some of that might be true in tech, where like, hey, we
Hmm.
want to see a hockey stick. When you go to Main Street, that is actually probably not that great, to see, wow, like you went from like 5 to 10 within a year's time. So maybe let's unpack some of that because you've seen
Yeah,
that.
that's
Yeah.
good. And funny enough, I was actually dealing with a valuation this morning that has this exact issue. You had
Hmm.
sort of sustained similar growth from 22 to 23, 23 to 24, but 25 is literally hockey stick. I'm talking about going from a 13% net income all the way up to 27%. That's a lot.
Double. Yeah, yeah,
That's
it's double.
literally
Yeah.
double. Um, at the end of the day, when it comes to evaluation, it's all about the narrative. It's all about the story, right?
Mm.
What is the story that's being told there? Now, in some cases, a hockey stick can be fairly, well, I'm going to use the word acceptable. Like it's not always a bad thing to have a hockey stick. And just to sort of rewind a little bit, the reason that hockey stick what Seb is referring to there, why it can be a negative thing for your valuation is because it's an anomaly. It appears to be an anomaly, right? Historical data shows this, and then your last year is like this. So what's to say that your next year isn't going to be that, right? So
Right.
when you're talking about evaluation, you're going to get credit for that year, but you're going to get credit in the context of the previous 2 years. And you're going to have to do some serious explaining about why you had that growth, right? And in some cases, like in the case of the valuation I was doing this morning, it's actually a fairly okay thing. And what it is that this particular business owner completely restructured his profit modeling and the way that he runs his business. So that's not an anomaly based on sales. That's an anomaly based on profit margin, right? So his revenue was pretty similar year to year, but his profit margin is what skyrocketed. Well, we can explain that. Okay, 2025, he created a new business model that's going to now carry through in 26, 27, and going forward. So we're able to weight 2025 actually greater than 2024 and 2023 because of that. So in that case, it was an advantage. When
Mm.
you're talking about revenue, hockey stick, right? I mean, at the end of the day, one sort of a sub myth to dispel is that your revenue has a lot to do with your valuation, but it ain't everything, right?
Mm.
We have companies that are doing 20, $25 million a year that their valuation is like 5 or 6 million.
Interesting.
Because at the end of the day, it comes down to what the EBITDA is, right?
Yeah.
Um, the
And so
revenue
how would you have such a low valuation for a $25 million company? Like
just a
just
super low
losing
profit
money
margin.
or whatever. Yeah, like
Well, not losing money, but just a super low profit margin, right? So on a $20 million
yeah,
company,
yeah.
their EBITDA is 1 million, which is low, right? That's 5%.
Yeah.
And best case scenario, you're getting this particular business owner is getting a 5x. So you got a $5 million valuation on, and that's very simple math, right? That's just I'm
Yeah.
kind of
Sure.
glazing past it. But yeah, revenue doesn't necessarily revenue will help on the multiple side of things. And I think I was explaining this to Anthony the other day, if I remember correctly. But the idea
Mhm.
is once you hit certain revenue thresholds,
Sure.
that contributes positively towards the narrative about your business, right? If I'm doing $20 million, I've probably got my crap together, right? I've probably got an HR department. I've probably got good staff. I've probably got recurring business. All these things that sort of can be inferred by that revenue, right? But at the end of the day, the revenue is not the end all be all. Now, there are ways to value your business according to revenue, where you're going to get, a much lower multiple, in some cases in the decimals. But at the end of the day, the typical way to value Main Street is going to be based on that EBITDA or the seller discretionary earnings.
Mm. Yeah, thanks for that. So let's talk about the book of business. So on my
Mhm.
end, working with customers, a lot of times we talk about the importance of not having three clients that essentially are 90% of your revenue, right? And I think that is actually even more important if you're considering a transaction. And I'll tell you actually a personal story is, I've been an investor in a few companies. There's one 12 employee company that I invested, six figures into. And what ended up happening is our top three clients, when I invested, ended up, within 18 months, for multiple reasons, market changed, conditions, decline, like basically not continuing their contracts. So what that meant is, why I invested, we were in like well over seven-figure revenue, and then within 18 months, like the company was not in such a great spot anymore, not during the kind of profit that we had anticipated. So, tough learning, right? And then that's oftentimes how we learn. So my value of the shares of that business, the valuation has actually shrunk. Thankfully, this is like a one-off situation that I've experienced, but I've learned the hard way where, wow, those like top clients that, why I invested, going to CEO, they're amazing clients. We have, fantastic outlooks. And, quickly enough, within 2 years' time, that wasn't the case anymore. We had to do some restructuring. So that was,
Hmm.
painful experience. But let's talk about the book of business because, if your revenue is kind of consolidating like a few clients, that is a risk. So let's talk about that.
It's a major risk, right? And we refer to that as customer concentration, right? So
Mhm.
and we see this all the time. And here's the thing to understand, just generally speaking, as it relates to selling your business and valuations. We can give an opinion of value. We can get, we can give a valuation up, down, and sideways. But at the end of the day, the buyer is looking for something very specific, and they are going to make offers based on what they're seeing. It's going to be based on the math, but it's going to be based on what they're seeing. It's also going to be based on what lenders are willing to lend on. So lenders are, because I mean, something like 95% of business acquisitions are done leveraging financing, right?
Mhm.
Even when you have the cash, it makes more sense to finance it. So because of that, you are at the mercy of that final SBA sanctioned appraisal, right? And so things that they're looking at is things like risk of customer concentration, right?
Yes, yes.
That's a big deal. So, you know, it can really present a problem unless there are certain factors that are in place. For example, we had one business where their customer concentration was pretty high. They had, I think, their top three customers were like 80% of their revenue, which was insane. But all three of those had 5-year contracts. That makes it a little bit more tenable, right? Because now
Yep.
I've got a long-term contract. I know what the next 5 years are going to look like. Me as the buyer, I'm looking at it and saying, all right, well, at least I know I've got a runway, right? And so that sort
Yes.
of helps to mitigate some of that risk. In other cases where where there's not contracts, which I would say happens more often than not, it
Mhm.
does. It's a difficult thing. And so increasing two recommendations that I always make are a obviously increasing your book of business, right? Bringing in
Mhm.
more large scale customers, and two, really putting work into creating recurring revenue streams, right? Because
Yes.
that is a huge piece that a lot of business owners miss. We see this a lot, particularly in the trades, where it's a lot of project oriented work. And some will have maintenance divisions, some won't, right? And even though those maintenance divisions may produce less revenue, that is a lot of times what a buyer is going to see from a risk mitigation perspective. That's going to not necessarily change the value, but strengthen the value or weaken the value, meaning
Mm.
strengthen or weaken the narrative for the value, right? Justify it.
Yeah. Yeah.
So that's a big red flag whenever I'm valuing a company when customer concentration is is uh is 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 really high, and it's not, you know, yeah, that's what we
So,
don't want.
so building on that though, Joe, so customer concentration, so like number of clients and then how much revenue that is. Okay, so that's one
Hmm.
thing. But what about Main Street, one of the common things about small businesses, um, the owner is also probably like taking the business that's coming at them, which
Hmm.
means sometimes you'll have, like varied business activities. They're not really all focused. So you feel like there's like essentially like one part of the business is doing this kind of revenue for this type of client, and then something else on this side, and then something else on this side, which means in the end, the business is kind of spread in different directions and maybe doesn't
Hmm.
have a strong specialty, kind of covering things
Hmm.
on all angles. So what about that when you're evaluating a business and its potential and potential sale price, how does that factor in? Because I think there's something there, right? Where if you're not focused and maybe to go very concrete, like an example, you might be having part of their business is like serving homeowners with, these needs with your trade business, but then you got also a little bit of commercial, but you're also like working, some other things here, industrial and so you're kind of spreading many different directions. And in the end, like the founder has been kind of working all this for the last 2, 3 decades. So he knows the ins and outs, but it's going to be maybe pretty difficult to delegate any of it to anyone because it's all pretty intricate and there's no playbook for it. So yeah, let's
Yeah,
explore that.
and that is the thing, right?
Yeah,
What you just described is more a function of, transition and the type of owner that's going to be able to come in and really put that puzzle piece back together without the owner who's sort of got everything up here in terms of how
right.
the machine works. So
The
that sort
Joe
of speaks,
show. The
right?
Joe show.
Exactly,
Yeah.
exactly. So
Yeah.
that sort of speaks to the necessity for creating standard operating procedures. The more that a business owner has on paper in terms of how the business runs, on paper or digitally, obviously, but the more you have, the stronger your the narrative and the justification for your valuation is. Um, you know, when you talk about, I mean, because there is also on the more positive side, there is the idea of revenue diversification, which is
Mm,
okay, right? As long as it is part of an efficient machine that can all
yeah.
be traced back. But when you're talking about an entrepreneur, let's say, for example, something we see a lot is, let's say, a marketing agency, right? Where really it started as a one-man show who sort of built his team. He had work coming at him from all different directions. Something as broad as marketing, where you can go, you can be, in digital marketing, running, social media ads. You can be doing social media management. You could be doing AV. You could be doing web design. I mean, there's so many different directions you can go, and that is there's definitely weakness to being spread from that perspective.
Hmm.
Figure the smaller that your business is, the more of a red flag that it is if you're spread all over the place. If you've got a 20 $25 million business where you've got 5 million in digital assets, you've got 10 million in AV, that's
Normal.
that's normal, right? But
Yeah.
when you're talking about, I did 850,000 this year and I did a project for this guy and then I did a project for that guy, that's a very difficult business to sell.
Yeah.
Unless there is a clear, and because again, the question you have to ask yourself as a business owner is, what is someone buying? What is the buyer buying exactly, right? Because
Mm.
a lot of times small business owners run their business like a job, right? Like where they're basically a glorified project manager. And again, they're taking in revenue wherever they kind of can. And that's fine, but you haven't really built a machine at that point. You've
Hmm.
built a job. And that
Yeah.
job is pretty heavily dependent on you. And
Oftentimes consuming you as well, right? Yeah.
oftentimes consuming you. And that's, we see that a lot where you get a sort of a one man show who's been totally consumed. He's doing fine. Maybe he's taking $500,000 a year home. Great, great, great. But it's kind of difficult to sell because that's not really like, there's no
The
asset there.
business. Yeah.
Right. There's nothing clear, right? Because what's to stop somebody else from just doing the exact same thing on their own? Granted, it's maybe going to take them a little bit longer. So the value for that business is that you've given them a little bit of a head start, maybe. Um, so it is,
Mm.
there's more to it than that, but it is, to your point, it's definitely a weak point to have a business like that. And I mean, I wouldn't sell a business like that.
Yeah,
Um,
yeah. One of the great reads I had done, this is like, I'm thinking almost like 2 decades ago, but one of the great reads that reopened my eyes, on creating a sustainable business models is the E-Myth, right? That book where it's like, essentially a lot of businesses, I would say the average small business in North America, you got essentially like a founder with about 10 helpers, and
mhm,
everything's about the founder. And even you
mhm,
could probably scale that to like 20, but essentially you got this person in charge of this team running the business, but it's you're continually playing superhero, right? You're like
mhm,
fixing everything, and you got someone taking a responsibility, but you're jumping in superhero, trying to improve the outcome. And the
mhm,
problem with that is that you're essentially limiting your own growth and success. You can't go past a certain level because literally like you're like every single process in the company is dependent on you. Every
mhm.
employee kind of like expects you to jump in eventually. So um, like from your experience, like how much of that are you seeing in the business transactions and like, when you're talking about like coming in earlier and creating something that's probably more sellable in the future, that's
Yeah.
probably one of the points that you must be approaching the
Oh, I
business.
see that
Yeah.
all the time, man. I see that all the time. And again, that in itself doesn't disqualify the business from being sellable because there are things that can be done. And sometimes it just means that you need a very specific type of buyer. Other times it simply means that, hey, you're going to get bought, but you're going to still work the company for a year or two, that the transition period is longer, right? Or maybe it's, a partial sale where you're selling the majority, but you're retaining, 10%, 5% even equity. And actually, in many cases, depending on the strength of the buyer, the SBA is requiring things like that,
Mm.
which is a pain in the butt, by the way. But
Mm.
um, but yeah, I see that quite a bit. And again, it is, I would say it is fairly, in terms of the businesses that come across my desk, I would say 60 to 70% of them are too owner dependent. Meaning if they were less owner dependent, it would be a more straightforward sale and probably a little bit of a better valuation. Because you got to figure it this way, right? If I own the business and I operate excuse me, if I own the business and do not operate the business, I'm
Mm.
drawing my salary of 100, my cushy salary of $250,000, right? But I'm not operating the business. So that $250,000 has nothing to do with the operation of the business. So when it comes time to actually do something about like when it comes time to sell the business, that amount can be added back to the bottom line because
Yeah.
that's seller discretionary earnings. Whereas if I'm an operating owner, my salary can get added back. Part of my salary can get added
Part
back
of
to the
it.
bottom line if I'm paying myself more than market rate would be. Again, there's different ways to look at this. We used to value things more where we would really add back any owner's salary because the idea is, well, if you have another operator come in, I'm not going to tell them how to run their business, right? They may want to pay themselves, they may not want to pay themselves. Um, but all that to say, yeah, it's if if I'm an owner operator and I am too deep into the business, it just makes the whole process harder. It really
Mm.
does.
And
But it can
I
be
think
done.
yeah, and I think if there's one message I'm sending out to entrepreneurs out there, and that I need to remind myself on a regular basis because I think we oftentimes make ourselves too crucial to the business
Yeah,
processes, and we need to remove ourselves from the business process if we want to scale, right? And so if there's one message to send out there is yeah, I do think there's if you can create a business that can essentially run mostly without you you're actually creating a business that you might not even want to sell. The good news, that is that kind of business that you will eventually potentially sell for a whole lot more because you've created that system, right? So
100%.
yeah, I think
You know,
that's
to
the goal.
piggyback on that, where
Yeah.
you kind of said you might end up creating a business that you don't even want to sell. That's good. And one of the things that I often tell, you know, prospects that are 2 to 3 years out, or even more than that, is just don't wait until you're at the top. Like if you
Yeah.
picture like a mountain, you want to sell when you can see the summit, not when you're on top of it. Because if you're on top of the summit, if you've taken the business as far as it can go, and you're like, all right, now I'm going to cash out. Understand that there is no upside then for a new owner coming in, right? A buyer is going to look at that and say, okay, this is as good as it's going to get, right? And therefore, that's gonna reflect on the value. Because a lot, again, like going back to what I said earlier, it's about the narrative, right? It's all about the story that you're selling basically. And obviously it needs to be based on truth, but you can allow the buyer to dream. You need the buyer to have room to dream. Oh, well, hang on a second. They haven't tapped this market and they haven't done this. And this is these are the market insights for this industry, and there's definitely more runway. Like those are the kind of things you want to allow the buyer to have room to play with. But if you've sort of capped that out, a lot of times what ends up happening is business owners, they want to wait until they're at the top, but when they actually get around to selling it, they're already halfway down at the bottom because
Mm,
because how do you know when
tired.
you're
Sure. Yeah.
tired? Exactly. But also, how do you know when you're at the top? How do you actually know when you're at the top? Usually it's when you start coming back down. You're like, oh, that was the top, right?
Mm.
My point is, you never really know when the top is. So if you feel like you're going like this, now maybe the time to sell. because
That's super.
you don't know what next year's going to look like. 2025 was a weird year for a lot of businesses,
Yeah.
especially in building and manufacturing. Weird year, right? A lot of people, we saw a lot of this in 2025.
Yeah.
Um, and so it's always a gamble, right? It's always a
Yeah.
gamble of when to sell.
Mm. Joe, we're already at time, but this was an incredibly interesting conversation, and I feel like it's definitely something we'll have to do again as we unpack some
Absolutely, man.
more of these myths.
Absolutely.
And yeah,
I'd be happy
yeah.
to.
Thanks again for joining me, and we'll organize another one of these in the near future.
Sounds good, man.
All right. Thanks.